Welcome to our video on achieving consistent returns from the stock market. We understand that predicting stock prices accurately can be a real challenge. However, we're here to show you how it is possible to achieve a consistent return even in the face of uncertainty. Our primary investment goal is to earn 15 Bizuro INR per month with an investment of 10 lakh INR. It's important to note that while this potential return is enticing, it is not guaranteed. The stock market is known for its volatility, and returns can vary. Let's start by looking at the mathematical basis for achieving 15% returns. Over the past 2 decades, the Nifty 50 index has provided an average return of about 12.5%. By considering the combined growth rate of a country's GDP and inflation, we can gain insight into expected stock market returns. For example, India's GDP growth rate is approximately 8% to 5%, while inflation is around 6%. By adding these figures together, we arrive at a combined growth rate of about 14%. This reflects overall economic growth and suggests that stock market returns, especially for indices like the Nifty 50, tend to align closely with GDP growth, potentially reaching 5% to 15% over time. Now let's dive into 5 key points that can help you achieve these 15% returns. Firstly, we advise you to focus on the quality of the businesses you invest in, rather than trying to predict short-term stock prices. Predicting prices accurately is highly challenging and unreliable. Instead, focus on investing in companies with strong fundamentals, effective management, and consistent revenue growth. Reputable companies like Hindustan Unilever, Scholl may experience temporary price drops, but they generally perform well over the long term. We can see this in practice with companies in the steel industry who use futures and forward contracts to hedge against price fluctuations. Even large, well-informed companies like JSW Steel and Maruti cannot accurately predict future prices. Secondly, it's essential to develop an investment system that suits your individual style. Look at successful investors like Warren Buffett and Elon Musk. Buffett prefers to invest in companies with robust cash flow and predictable earnings, focusing on value investing. On the other hand, Musk invests in tech and innovative industries driven by a belief in transformative technologies. As an individual investor, it's beneficial to identify your strengths and areas of knowledge. Invest in sectors where you have expertise or understanding, as this can help you make more informed decisions and develop a suitable investment strategy. In conclusion, while the stock market can be unpredictable, it is possible to achieve consistent returns by focusing on the quality of businesses, developing an investment system tailored to your style, and considering the combined growth rate of GDP and inflation. You can aim for those desirable 15% returns. Remember, it won't be without its challenges, but with a thoughtful approach and a long-term perspective, you can navigate the stock market successfully. Are you looking to make quick profits by selling stocks early? Well, it's crucial to think twice before jumping the gun. As investing genius Peter Lynch once said, selling your winners and keeping your losers is like cutting flowers and watering weeds. So instead of hastily selling a stock that has increased in value, consider holding onto it if it represents a quality investment. Why is this important? Well, selling a successful investment too early might lead you to reinvest in lower quality stocks, ultimately diminishing your gains. By allowing your successful investments to grow and compound over time, you're more likely to see greater returns in the long run. It's an effective strategy that many experienced investors swear by. Another key aspect to consider is managing your ego and avoiding downward averaging. It's easy to let our emotions dictate our investment decisions, especially when a stock we purchased falls in value, but resist the temptation to buy more of the same stock just to avoid admitting a loss. Instead, focus on the fundamentals of the investment and objectively evaluate its potential. If the stock continues to decline, it's generally wiser to cut your losses rather than averaging down by purchasing more of the same stock. Diversification can also be helpful in mitigating risks. Consider moving your investments to passive options, like index funds, which typically offer lower fees and steady returns without requiring constant management. This way you can protect your portfolio from unexpected market downturns. It's also essential to update your investment systems periodically. The investment landscape is constantly evolving, and successful investors adapt their strategies in response to market changes and trends. Take, for example, the rise of FANG stocks, Facebook, Amazon, Netflix, Google over the past decade. It highlights how market dynamics can shift, and staying informed about new trends and developments is crucial. By adapting your investment approach to these changes, you can enhance your returns. Just look at Warren Buffett's investment in Apple. He recognized the changing landscape and made strategic moves to benefit from it. So staying on top of market trends and continuously updating your investment strategy is key to success. In conclusion, achieving a 15% return is not out of reach with a well-thought-out investment strategy. Emphasizing quality businesses and avoiding common pitfalls, like selling stocks too early, is vital. You can also utilize resources like Money Genius to aid in personalized investment planning. Remember, continuous learning and adapting your strategy are the key components to becoming a successful investor. So stay informed, stay focused, and watch your investments grow.